Welcome, everyone. Get ready for a deep dive into the latest financial pulse of a global giant, Caterpillar Inc. Today, we're unpacking their second quarter 2025 earnings release. And for this deep dive, our source material is the official report. You know, the full package. We've got the detailed financials, the segment breakdowns, even the internal charts Cat Management uses. So our mission here is to, well, cut through all those numbers, pull out the key insights, maybe find some surprising bits, and really help you understand what's actually happening behind the scenes with this industrial powerhouse.
Yeah, and this set of documents is pretty fascinating right off the bat.
Yeah.
Because it seems like a bit of a paradox, really. You've
Right.
got the CEO talking of resilient demand, strong orders, but then you look at the top-line numbers and, well, they tell a slightly different story. Declining sales, declining profit. It's definitely a mixed picture. You can see some clear financial headwinds pushing against what looks like solid underlying business.
That's a great place to start, that paradox. So demand is apparently resilient. Okay, let's peel back that first layer then. Consolidated sales and revenues, what are the headline numbers telling us? Well, consolidated sales and revenues for Q2 2025 came in at $16.6 billion, which is actually a slight decrease, about 1% compared to $16.7 billion in Q2 2024. So basically flat, but slightly down. Okay, but then when we shift to profit, the picture changes, you said, more dramatically. Profit per share was $4.62 for the quarter. That's down quite a bit from $5.48 last year. And adjusted profit per share, similar story, even a bit steeper. Dropped to $4.72 from $5.99. Ouch.
Exactly. And that's the big question, isn't it? You hear the CEO, Joe Creed, highlighting solid operational performance. He mentioned strong orders across our segments, demand being resilient, supported by infrastructure spending, energy needs.
Yep.
All sounds good. So why the slide in both sales and profit? And the documents, well, they lay it out pretty clearly. It really is a story of that strong underlying demand hitting some, let's say, very tough headwinds. You see, the documents kind of cut through that optimism pretty quickly. They show this tug of war. For consolidated sales, the biggest negative factor was something called unfavorable price realization. No, basically, that means Cat got less money per unit sold than last year, or maybe they just couldn't raise prices enough to cover their own rising costs. And that alone wiped $414 million off the top line.
Wow. So even with decent demand, they couldn't command the prices they needed, or maybe competition heated up. That's a significant squeeze right there.
It is. Now, it wasn't all bad on the sales front. This was partly offset by $237 million positive from higher sales volume, and that was mainly driven by selling more equipment directly to end users. That's the resilient demand Creed was talking about. There were also some minor positive bumps from currency fluctuations in their financial products arm, but that pricing pressure, that was definitely the main story for the sales number.
Okay, and you mentioned the profit picture was even starker. So moving from sales down to operating profit, what drove that bigger hit? Because, yeah, operating profit took an 18% dive. It went from about $3.5 billion in Q2 24 down to $2.86 billion in Q2 25. The operating profit margin fell too, naturally.
Right, and the biggest chunk of that drop, we're talking over $500 million, $504 million to be precise, came from unfavorable manufacturing costs. And the report is very explicit about this. It largely reflected the impact of higher tariffs. Persistent impact, it seems. And then that same unfavorable price realization we just talked about also hit profit hard. It directly squeezes margins, you see.
Okay, so tariffs are a recurring theme here, hitting manufacturing costs. Does the report give any hints about how Cat plans to, deal with that? Or is it just something they have to kind of absorb right now, given the global trade situation?
Well, the report mainly focuses on detailing the impact of those costs, rather than spelling out specific mitigation plans. But it definitely implies this constant battle for profitability. It suggests that, yeah, they're managing to sell more machines to end users, which is good, but these external cost pressures from tariffs, plus those internal pricing challenges, they're a constant fight. And it looks like they are absorbing some of those costs, which, eats directly into the bottom line.
Okay, let's shift gears slightly. What about their cash situation? How did that look? Caterpillar generated $3.1 billion in enterprise operating cash flow in Q2 25. That seems pretty robust. They ended the quarter with $5.4 billion in enterprise cash on hand, healthy buffer, and they put some cash to work too, right? $1.5 billion deployed, $7.8 billion on share buybacks, and $0.7 billion on dividends. Okay, now let's break it down. How did each of Caterpillar's main business segments feed into these overall results? See where these trends, like tariffs and pricing, really played out. Let's start with construction industries. This segment saw total sales drop by 7%, down to $6.19 billion, but its profit Wow, that plummeted by 29%,
Yeah.
down to $1.24 billion.
Yeah, that 29% profit drop in construction, it's not just a number. It's a bit of a red flag for that segment. And it comes mainly from that unfavorable price realization again. They just weren't getting the price they needed for their heavy equipment. And then compounding that was lower sales volume, largely driven by changes in dealer inventories.
Right, dealer inventories. You mentioned that. When you say dealer inventory is decreased, what does that actually signal for Caterpillar?
Good question. It basically means their dealers, their distributors, were selling off the machines they already had in stock instead of buying as much new equipment from Caterpillar to replenish those stocks.
Mhm.
And that's a big difference from Q2 last year, 2024, when dealer inventory levels were apparently pretty flat. So for Cat's construction segment, it's kind of a double whammy: less profitable sales per machine, and fewer overall sales to their dealers, particularly in some key regions. Yeah, but regionally, you really see it. Sales were down significantly in North America, 15% down, and Latin America, 20% down. And those were the regions where dealer inventories decreased. Interestingly, though, EAME, that's Europe, Africa, Middle East, and Asia Pacific, actually saw sales increase. And that was largely due to higher sales volume linked to dealers increasing their inventories in those places. So a real split picture. But unfortunately, those higher tariffs, if they continue to hit this segment's profit, it's pretty hard to.
Okay, moving on to resource industries. Mining and quarrying equipment, similar story to construction, looks like it, reported a 4% decrease in total sales, down to $3.09 billion roughly. And again, a substantial profit drop, 25% down to $537 million.
Yeah, the pattern holds. If we connect this back, once again, unfavorable price realization was the main reason for the sales dip. And for the profit drop, it was kind of a triple threat.
Yeah.
That same pricing pressure hit them for about $94 million. Then you had unfavorable manufacturing costs, $44 million, again, heavily impacted by higher tariffs, and also the profit impact of selling less volume, about $31 million, which apparently included an unfavorable mix of products too. So yeah, it's a recurring theme across these big yellow machine segments.
But then we get to energy and transportation, and this one seems to completely buck the trend, right? What drove the positive results here? This seems like the bright spot.
Yeah, the numbers look way different. Energy and transportation sales actually increased by 7%, up to $7.84 billion. And segment profit rose, too, by 4% to $1.59 billion. Absolutely. This is the clear standout segment in the quarter. And the growth here was fueled by both higher sales volume that added $326 million and, crucially, favorable price realization, adding another $139 million. So, unlike the other segments, they were able to get better pricing here. And if you break it down further by application, you see the real engine of that growth: power generation sales. They surged, up 28%, driven specifically by demand for large reciprocating engines, particularly for data center applications. That's a huge growth area right now, and it shows how traditional industrial giants like Cat are finding opportunities in the digital economy. Oil and gas was okay, up a modest 2%, mainly from turbines and services, though engine sales for gas compression were lower. Transportation, though, was down 7%, affected by marine and fewer international locomotive sales. But even within this strong segment, you still see the shadow of those unfavorable manufacturing costs: $154 million negative impact. Again, reflecting higher tariffs. It's just a reminder of those persistent external pressures, even when things are otherwise going well.
And quickly, the financing arm financial products segment, how do they do? Also showed growth, right? Revenues up 4% to $1.04 billion, and profit up 9% to $248 million.
That's right. The revenue increase there was mainly from having higher average earning assets, basically, a bigger loan book, especially in North America. And growth in insurance services, too. Profit got a boost from equity securities and those higher earning assets, even though they had a higher provision for potential credit losses and a slightly lower net yield on their assets. And actually, there's a key detail in their numbers for understanding financial health, something called past dues at Cat Financial. They actually improved, dropped to 1.62% in Q2 25 from 1.74% a year ago. That suggests, better credit quality in their lending portfolio, which is definitely a positive sign, even though write-offs stayed flat at $18 million.
Okay, so let's try and pull this all together. We've gone through the segments, the top line, the bottom line. What does it all mean? What really stands out from this deep dive? For me, it seems to be the pervasive impact, almost inescapable, of two big things: those challenges with price realization getting the price they want, and that consistent drag from higher manufacturing costs, largely, as you said, due to tariffs. These just feel like major headwinds that are clearly hitting Cat's profitability, even while, as the CEO says, overall demand remains pretty resilient.
I think that's spot on. It's a really crucial lesson, isn't it? In understanding how these big global market dynamics and policy decisions like tariffs can directly flow down and translate into lower operating profits, even for a massive company like Caterpillar. The documents really show that while, yes, Cat is seeing strong underlying demand, you see it in higher sales to end users, you see it in growth areas like data center power. They are simultaneously battling these significant external cost pressures and maybe some internal pricing challenges too.
Yeah.
It just highlights how you really need to look at the why behind the numbers, to get the full picture of their performance.
Absolutely. From the overall revenue shifts to those segment-specific wins like energy and transportation and the losses like in construction, we've really seen how a global industrial leader like Cat is navigating a pretty complex economic landscape.
Yeah.
Where, yeah, strong demand doesn't automatically mean stronger profits anymore.
And it does raise an important question, maybe something for you listening to think about. As these global companies, like Caterpillar, keep facing challenges, fluctuating prices, tariffs, but at the same time, they're capitalizing on new growth areas like data centers. What does this tell us about the broader shifts happening in global demand? And maybe about the resilience of different industrial sectors? And perhaps, what's the evolving playbook for actually achieving profitability in this interconnected but increasingly complex world? Something to mull over.